Hey everyone, wanted to give you guys a quick walkthrough of my stock and option portfolio on this account here. And just to kind of give you an idea of the reasoning that I go through when I'm looking at these options, right? And just so it'll give you a perspective on how you can reason with on your option positions. And today is April 26, 2021. And as I speak right now, coronavirus is surging like crazy in India. In the US, we're in pretty good shape, but India looks really bad. They registered a few 100,000 cases just in one day yesterday, and I think they're on track to overtake US in the highest number of cases in the world. Uh, I see that coming in less than a month here. So really unfortunate situation. But anyway, that's what's going on right now. That's what's the highlights. But let me quickly walk through some of my option positions here. I generally don't, I'm not trading any stocks anymore because I realize that just buying stocks is essentially a very inefficient use of your money, is how I see it at this point anyway. So I'm looking into options. And primarily, my strategy is to sell options. So I'm going to show you what that means really quick here. As you can see, these are the positions that I have. I have a few futures positions as well. I'm not going to cover those. There's an Australian dollar position. There's a natural gas position, futures position, and a soybeans futures position. Um, all of which are red right now, which is okay. Which is okay. I've analyzed them and I'm okay with the risk on those currently. But let me walk through the stock positions and I'll walk through what I went through, the reasoning that I went through when deciding whether to keep them open yet still or to close them out, right? And I did close out a position today, and I'll also walk through why I did that. So here's Pinterest. So in Pinterest, currently the stock is, so by the way, this is Tastyworks platform. And if you guys are not familiar with it, I highly suggest, if you guys are interested in looking into options at all, or in general trading, I think you should definitely consider Tastyworks platform, because just the way the platform is laid out, I think it's laid out in a way that you really understand how options work, the mathematics behind it, and all that stuff. So I'm slowly transitioning from Fidelity to Pinterest. Sorry, to Tastyworks. So speaking of Pinterest, so currently the stock is trading at 76.73. I have a short strangle in here. I have a 65 put and a 95 call. What that means is if I go to the trade page, the expiration date for these options is May 21st, which is 25 days away from today. And as you can see here, I have, let me make this slightly bigger. So, all right, the stock is right here, 76.73. I have a 65 put and a 95 call that I sold. Both the positions, I sold them together for $4.12. So that's $412 for the 100 share contract. So what this basically means is if the stock stays anywhere between 65 and 95 by this date, May 21st, I keep the $412. So I'm taking a bet here that the stock is going to stay between these two prices. Okay. So anyway, so as of today, my position is I have $139 of profit in it, because when I sold it, this position was, I sold it for $412. It's trading today for $2.73, so basically $273. So I have $139 of profit currently in this position. So had I closed it out today, I would have made this money. So the question is, should I keep it open further because there's this much more money I can still make, or should I leave it open? Sorry, should I leave it open or should I close it out? So this is how you'd want to assess this. So the capital required for this position is $1,000, right? So what I would need to consider, what I would need to think about is, am I willing to, from this point on, from today, I mean, as it stands today, am I willing to risk $1,000 or am I willing to lock up $1,000 in this position so that I can make $2.73? Am I willing to lock up this much for another 25 days, right? 25 days to expiration. Although I never actually leave the trades all the way to expiration. I close them out around 21 days. That's the recommended approach, because as you get close to 2 to 3 weeks, you have something called high gamma risk, which means as the stocks moves a little bit, the price of your options moves a lot. So in order to avoid that, we either close out the positions at around 21 days or roll them out to next month. So in this case, I looked at this position. So I have $139. I'm going to close it out either way in another 3 or 4 days. So should I close it out today already, right? I have 33% profit realized. I can, if I close it out, I'll free up this $1,000. I can use those $1,000 for another, maybe a bigger profit trade, right? But however, I did not do that because as I looked at Pinterest, Pinterest has, oops, let me minimize this. Pinterest has earnings coming up. So on Tastyworks, in the trade page, you can see here when earnings are coming up for a particular stock. So Pinterest has earnings coming up on April 27th, which is tomorrow. So if I hold it for another day, and I think they have earnings coming out after the close tomorrow. So if I hold it for another day, essentially there'll be a large implied volatility crush on after that date. So as we get into April 28th, there will be a large implied volatility crush, which will basically reduce the cost of these options by a lot. So since the stock price is still quite a bit far away from my strikes, it's still like right smack in the middle. So I still have, very low risk in this trade. And if I hold it for another day, another full day, I'm going to realize a lot of this profit. So that's why I left this open. So I'm going to close this out. I'm planning to close this out on the 28th, right after the earnings. So anyway, that's why I left this one open. Now Twitter position, I'm in the red here. I have a short put. Actually, I also had a short call, which I closed out earlier. So let me show you that. If I go to activity page, well, actually, let me go to a different section. I'll go to the option chains for Twitter. So you can see here, initially I had sold a strangle for $4.78, and I closed out the short call when the stock went down. The call had basically lost its value. So I closed it out for $1.80. And the put also, actually the put it's not in the money, but it's, the put, the strike is close to the stock price right now. But it did go down in value. It's currently trading at $3.37. Overall, I have $2.98. So 200 well, no, I actually am negative on this position. I have, this is what the short put is trading at currently. Right. Well, it was the last price anyway. Actually, let me see. I sold this for $4.78. I paid $1.80. So this was the This is the difference of those two. And okay, this is trading for 337 right now, as you can see here. So I'm actually in the negative for $39 in the negative, right? So $39 in the red overall as of today. However, I'm reasonably bullish on Twitter, and my put is actually not in the money. The stock price is still above the put. So, and let's look at earnings. Twitter has earnings coming up later this week, April 29th. I'm just hoping that Twitter is going to go up from this price in the next couple days, or after 29th, there will be an implied volatility crush. So a lot of this um, premium is going to come down from this from the stock. So that's why I left this open. And in the worst case scenario, I still have 25 days here. So after the earnings date, if the stock doesn't go up and if I'm not profitable, I'll just roll this position out into the next month. So I think that should be fine. So that's why I left this one open. Now Netflix, I had sold a strangle. Let me go back to the option chain here. All right. I actually had sold an iron condor, which is a short put spread and a short call spread. So short put spread below the money and short call spread above the money, right? The stock was trading at 550 or something like that when I put this trade on, and I put a short put at 515, 505, and as you all know, after earnings, the stock price dropped dramatically. And this was a weekly. I had sold it for 3 days, on when it was 3 days to go, and the stock price dropped that day. And what I did was I closed out the short call spread because it basically lost all its value. So I closed that out, and I rolled out my short put spread to the monthly cycle from April 23rd to May 21st cycle for a 92-cent credit here. So basically $92. And so as of today, I am in the red in the Netflix position, overall Netflix position. I am $400 in the red, $399. However, the stock did go up today a little bit. My short put is only at 505. So if the stock keeps going up in the next couple of days, I'm going to get back to profitability. So I should be good on this. So I'm waiting on this, and I still have 25 days to go. So I'm not too worried about it. Again, in the worst case scenario, I can still roll this spread out to further expiration when it gets to around 21 days to expiration. So that's the Netflix trade. Then there's the Roblox. This is interesting. So the stock is right in the middle, as you can see, around $75, and I have a 65.80 strangle. I have a short put at 65, short call at 80. The stock is in the middle. However, I'm still in the red. That's because there was a huge increase in implied volatility after I sold this. So both my short call and short put are are in the red. So I'm $200 in the red. So how do you handle a situation like this? Right, that's the question. So your stock price hasn't moved. It's still in between your short put and short call, but the implied volatility went up so much that both of your options are in the red. So what can you do in this situation? One thing you could do is you do dollar cost averaging of implied volatility. So what I mean by that is, let's look at the curve and analysis mode. So my break evens for this position right now is $85 and $60, right? Those are the break evens right now. So what I could do is because after I sold this, the implied volatility went up. What I could do is I go to the trade page and sell another strangle at the break evens. So I could theoretically sell the 8 because my break even was at 85. I could sell a short call at 85 and a short put at 60. So what I collect another $4.55. So as you can see, implied volatility is high. So I'm able to collect quite a bit of premium here. And if I go look at my curve again, what I just did is I essentially expanded um, my strangle width. So my break even now is 87.5, 87.37, as you can see up here, 87.5 and 57.5 instead of 60 and 85. So I slightly increased my width of my profitability, and I'm collecting some more credit. So that's one thing I could have done. I just didn't do it today because I didn't have enough buying power. I had some other positions that I had closed out, so my buying power is up now. However, I wanted to have some buffer anyway, so I just left this open. I'm gonna just watch and see how this goes in the next couple days. So that's why I left all these trades open, and I also closed out one position today, which I can show you guys. I go to activity page and I'll filter to today. I'll take out the stock filter. I did close a soybean future position, but I also closed this square position. So this was interesting. The square position, I had sold it for, actually, let me just show you in the options chain so it'll be clear. This square position, I had sold it for $4.35 and it was trading today at 417. So I only had $18 profit. So now why did I close it today? Why didn't I just wait it out and wait for the theta decay to happen, wait for the extrinsic value to go away? The stock was still trading. The stock is right now at 4 to 55. It's still in between my short put and short call. So why did I close it out? The reason I closed it out is because right now I have some profit, right? I have $18. However, if you look at Square, Square has earnings coming up on May 6th. Today is only April 26th. So I have another 2 weeks to go until this earnings date. So the implied volatility is going to keep going up from today to May 6th. It's going to keep increasing. So what that will do is it will nullify my where the page go. It will nullify the theta decay on this position because the IV is going to keep increasing. So I will not realize a lot of theta decay. And in fact, if volatility goes up quite a bit, and given how Bitcoin price is kind of wild right now, the volatility in Bitcoin is pretty high, and Square has a lot of Bitcoin positions. So given that, I was expecting volatility to be pretty high in Square as well, and it'll increase all the way through earnings. So I was my reasoning was that the short positions will keep increasing in value, and if at all, I'll only realize a loss on this thing as we go forward in the next week or so. So that's why I decided to close out this position today, and then I can use that money that's freed up to do another more profitable trade. So all right, so that's basically my positions and how I analyze them today. Hopefully that gives you good insight on how you can do your analysis. All right, I'll talk to you guys later. Over and out.